as we're walking through this sample property here. This was an investor deal that we had done recently, and we are going to take a look at it in two scenarios. So one where you're purchasing the property, owner occupant, getting a mortgage, and then somewhere down the line, your plans change and you decide, you know what, let's rent it out. So the numbers are going to look initially like an owner occupant type of deal. And then we're going to talk about the rental numbers, and then you're going to look at it from a different perspective. So I'm going to go rather quickly through it, but I'm going to talk through each line. So let's say you were able to purchase a property for $321,000. You put 20% down, and then closing costs typically range from 1 to 2% depending on your lender. 1% is typically for cash, or usually a little bit more if you're lending, but we kept it conservative at 1%. And let's say that you had $10,000 in make-ready costs. You had to buy new appliances, do some paint and carpet, miscellaneous things to get it in shape for it to be move-in ready. So now you've got your down payment, so that gives you a little bit of equity. You've got a remaining loan balance around 256,000. So now let's say that you're expecting appreciation to slow down from the rapid fire pace that has been going for the last couple of years, and you go very conservative and just say 1% appreciation. Today, if you had to go and sell the property within the next year, you can expect to net somewhere in the area around $208,000, because you got your purchase price, which we'll get to show a little bit further down the screen, minus paying off your mortgage, minus commissions and holding costs. So then you know what you're walking away with after everyone gets paid. But let's just say you don't need to sell today and you're currently paying your mortgage rate. Yes, right now mortgage rates are in the sixes and sevens. No longer are we seeing 4.5, but we want to put something as a blend between what it was over the summer and what we are now. And let's just say you've got 20 years left on your mortgage. So you've got mortgage payment around $1,600, and this effective interest rate just takes into account interest charges. So before I go down to the sell expense, I'm going to go up to the hold and rent part briefly. So let's say you got a great job transfer and you're leaving town and you want to keep the property and rent it out. You look online and you say, okay, based on what I've seen on a few different sites, I can rent this for about $3,200 easily. I don't expect any other monthly income from, say, renting out the basement or storage in the backyard or laundry facilities, anything like that that could add to that bottom line. So we left it at zero. Factoring in a benchmark 5% vacancy rate is going to take some time to get the tenant in place, or you may have a tenant that stays for a couple of years, leaves, and then it takes you a month or two to rent it up again. So you budget that in to say that you're not going to get every penny out of this monthly rent. And you do expect, though, that rent will increase 2%. So all of this is bundled into the formula. And of course, you can change these as you see fit for yourself. Some of these like benchmarks are made it to be easy with the evaluation. You budget 10% for management. It's towards the high side. You can look between 6 to 10% in most markets for a management fee based on the services you're looking to have and the provider you're speaking to. But let's just say you went full service, asked the company to include leasing and everything in one package, and you're paying 10%. If you get more at the end of the day, great. But let's budget 10% on the cost, budget for repairs and maintenance, because as long as you've got real estate, you're going to have something that needs to be taken care of. So you might as well put something aside to take care of it before the tenant leaves and now you've got zero rent because you didn't make a couple of $100 repair for a AC unit that wasn't working optimally, or a furnace that goes out in the middle of winter. Property taxes, this is going to change county by county. However, for this property in Cherokee County, the median property tax rate is 0.82% of the home value. Other jurisdictions like Cook County, Illinois, home county of Chicago, has the highest property tax rate in the country at the moment. So you're going to have different values based on where you are in the United States. Insurance is also going to be different based on your neighborhood. These can always change, and your insurance provider will help give you a estimate that's truer. Once again, we just put a benchmark here to start. If you had an HOA, you're going to put those costs here to add to those expenses. If you were covering utilities for some reason, an older duplex or multifamily where everything is still master metered, and so the landlord's paying those utilities or billing back to tenants, you want to put those in there so you know those costs. And then you expect, even as you're increasing rent 2%, your annual increases, i.e., property taxes, are going to go up 2%. HOA fees may go up a little bit. You may have a little bit more repairs and maintenance. So you just want to budget accordingly on both ends. And then, of course, income taxes. You're making this money, but Uncle Sam wants their piece. There are different ways for businesses to take advantage of lower tax rates. However, for the sake of this example, we kept it as if you were buying this in your own personal name and you're still paying income taxes on an individual basis. So if you expected to sell, you can look at for this property about $511,000 to sell it for, and then this appreciation rate would take into account if you were looking to hold it for the remaining 20 years. Your cost to sell, commissions, closing costs, maybe potential buyer concessions are included there, and then capital gains tax. If you're budgeting for that expense as an owner occupant, there are ways that you can avoid some of that. But however, we budget worst case scenario that you've got to pay Uncle Sam on the income and on the capital gains. And if you don't, then great, that's more money in your pocket. But here we just have the management fees broken out, repairs and maintenance as a dollar item, along with property taxes, insurance, and if there were any HOA or utilities. So this way, you've got a great way to break down line item by line item what it would look like if you were to rent or if you were to sell. This is something that's available for any client or prospect that were interested to use it. We can offer this to you at no charge. However, we also do have another tool that gives a simpler version in a more graphical format from folks that like to see a little simpler presentation. I'll show you our market report. So looking at this property again as well, you see where you could potentially sell it to an owner occupant at the 511 price. But if you had a property that needed a lot of repairs and it was better suited for an investor that was potentially looking to renovate it and resell it, you may get an offer in this range. This section gives the details on the property, 5 beds, 4 baths, when it was built, square footage, and then you've got your lovely picture. Going into a comparison, we've got the traditional resale option on top, but if you want to get an idea of what it would look like if you were to seek an investor offer versus a traditional rental or a short-term rental, we break out those three options for you so you can see in multiple scenarios where you may have something that makes the most sense for you. So let me move up just a little bit. So for an investor offer, after you took into account what they would budget to make the property ready for their final use for a rental or resale, you've got that number there, which is potentially about $10 a square foot on average. Every property is going to be different, but once again, it's an average here. Resale closing costs, commissions, buyer concessions, anything that is going to come out of your pocket at the end, not including mortgage, because we don't know at any given time if you've got a mortgage on the property. So this is a quicker analysis compared to the first one we showed. And then management fees, while you're waiting for this buyer to close, you've got holding costs that you've got to consider. You're making mortgage payments and taxes. You're covering any ongoing maintenance and maintaining your lawn. So you've got a budget for those costs while you're waiting for closing day and that check to clear. So you can estimate a sales price right around here at the 423,000 mark if you were looking for an investor type offer. If you said, I like both of those numbers, but I'm thinking renting is going to be where I'm looking, but I can't decide if I want to do a traditional type of rental or a short-term rental. Could you walk me through what those look like? So, very simply put, I'm going to scroll down just a little so we can see the full scenario here. So everyone's going to have your gross income. You got your monthly rent rate of 3,200, which breaks out to an annualized rate here around 38,000. On the short-term rental, you've got your daily rate and your occupancy percentage. Not every short-term rental is rented year-round 100% of the time, and every property has an area and a neighborhood percentage, so you can budget accordingly for your annual estimated revenue on both sides. The expense ratio is part of the challenge when it comes to analyzing or evaluating both options. A traditional rental in the landlord business, you're providing a space for people to occupy long term. So your expenses are mainly going to be focused on taxes and maintenance and making sure that you can maintain a property that your tenant wants to keep paying money for. With a short-term rental, however, your operating expense goes up significantly because you're more in the lodging business. So you've got taxes that are a little bit different between the landlord business and the lodging industry, expenses and deductions that you can write off on that basis. But then you also have ongoing expenses like changing sheets more often because every guest is looking for a fresh, clean experience, to those bottles of water that you find in the fridge every time you go into a new place to stay, or those appliances that are on the countertop to make you feel like you're walking into a place that feels like home. All of those different things change your costs, and so your operating expenses are going to be a little bit high on the short term side. Now, that being said, you take a look at the net operating income in both scenarios, and you can make a decision as to which one you would prefer. But at least you've got the numbers in hand to sit there and make an educated decision and figure out which way you would like to proceed. So when you're ready to talk to an advisor, you can sit there and say, I've looked at my options, I've decided which way I would like to go. Let's go with this pursuit. Or I would love to talk to somebody a little bit more about these options and learn a little bit more about which option makes the best sense for me, but at least you've got the data in front of you to make an educated decision. And then, of course, on the last side, we give a couple of tips on if you're considering selling, you've got some keys to success. And if renting seems preferable, then you've got some keys to also consider, some principles that'll help you win long term. And at the end of the day, a lot of it comes down to some of the same benchmarks. You know, you present and you price your property well, you're going to succeed, whether you're looking to resale or to rent. Everybody's looking for a place that they can call home. So if it looks good and it's at a price that's attainable, you're going to have a lot of interest and you're going to have a lot of potential applicants that you can choose from. Choosing your agent wisely is going to be your second key. Just because someone is next door to you does not always mean that they're the most knowledgeable or the best fit for your strategy. Short-term rentals are a great opportunity and have become a lot more popular in the recent years. However, as we mentioned, the expenses can add up. Whether selling or renting, repairs and updates do not always guarantee higher profits. So, speaking to an advisor about which types of updates give you a more perspective, higher return on that investment will be key before you put out that money and then find out that you are not going to get that money back. However, even in a rental, you do want to pay attention to making a presentable property. Those renovations and updates do matter because everyone wants to feel like they're in something that reflects their lifestyle and their willingness to live here properly. So skimping on certain things makes people wonder, what else am I missing? So thank you, Krista, for the opportunity to walk through some of this and discuss how you can look at a property that you're currently looking to buy or one that you own and see what your options are at this point in time.
Awesome. So, guys, this is something we do every day for our clients. We definitely make sure that every dollar invested will have a robust return attached. So, if anyone is interested in getting a property evaluated, just drop a line in the chat or respond to the follow up email mention us on social media. We'll get back to you. So, moving on,